Hi, Brett Swarts here, Capital Gains Tax Solutions. This video we're talking about a case study, and it's a common case study and a fact pattern that you might be in or someone you might know might be in. And it's a husband who, let's say it's age 55. They earn about $5 million annually from profits from an operating business. Their business has been growing about 7 to 10% per year. They're considering selling. Their net worth is about $60 million, including the business, and about $10 million in non-business assets. They have about $2.3 million in business debt and about $650,000 in personal debt. Annual spend about $800,000. Maybe you fit this fact pattern, or maybe someone that you know or a client of yours is this fact pattern. And so we're going to break down how some capital gains tax exit planning can help defer capital gains tax, eliminate some estate tax, as well as defer income tax. So step one is getting very, very clear on what is the tax liability upon your sale. Also, what is the tax liability on your estate tax? We have to define the problem before we can come with solutions. And before even we get those numbers, you want to get really clear on what your family mission, vision, values are for your wealth and the longevity of your estate. What this looks like, how much charity do you want to give to, how much do you want your kids to have or not have, to inherit, and ultimately what's the vision for the wealth long term. I had a chance to spend a lot of time here in the last few months studying and practicing with a coach of mine who taught me something called the 100X Roadmap, and he wrote a book on this, and his name is Lloyd Reeb. And the biggest thing he found that with families for the estate is not having clear vision, mission, vision, values for the family when it comes to how and where the wealth is going to go. And so I would encourage you to get really clear on that, get clear on your personal mission statement for the rest of either your career or where you see your life going. This is going to help you to make sure you're not building a ladder on the wrong wall, or climbing a ladder on the wrong wall, or building the wrong wall. It's really important to have that crystal clear. Once you have that crystal clear and you're looking at some of your numbers, then you can start to kind of roadmap where you want to go. So the first question would be, if your valuation of your business, let's say, is $50 million and your estate is $60 million, to understand that estate tax is now the biggest, we call it elephant in the room, versus the capital gains tax, which we call that the tiger by the tail. A lot of us who have invested in real estate have been taught that the 1031 exchange and deferring capital gains taxes and getting a stepped up basis is the best way to build wealth. And it certainly is, until you hit a certain income and or estate value with a net worth within your estate. So what we're looking at is estate tax versus capital gains tax. And so I want you to write down this rule. You can either have your wealth, your capital, inside of your taxable estate, which is and can get a stepped up basis as of the tax laws as of right now, depending if that stays around long term. Or you can have it outside of your taxable estate, which would eliminate the estate tax, but you can't have both. So you got to be really clear on what you're trying to solve for. As a case study right now, let's say we're trying to solve for the $50 million valuation of the business. Now, I mentioned too, it had about $2.3 million of debt. Now, let's assume the basis is also zero. They started it from scratch. So how do we solve for the estate tax? Well, number one, we can build an irrevocable trust that upon sale of the business, instead of receiving all of the capital at closing, and therefore it's staying inside of the taxable estate, the business of $50 million can be sold to an irrevocable trust before the irrevocable trust sells it to the ultimate buyer. If we do it in the proper order and set it up prior to the close of escrow, the ability to eliminate the estate tax has just gone up 100%. So this is 100% elimination of the estate tax. There's not a lot of elimination of taxes in life. And so this is one of the ones where you want to pay really close attention to, because outside of this, if you just sell and you receive and pay capital gains tax on that $50 million, now you're not only looking at capital gains tax of probably 20, 30, 40, 50% of the sale, but also it's still inside of your taxable estate, and it's not as easy to get it out of your taxable estate when it's just sitting in cash. So this is a key moment for this particular husband and wife. Again, they're 55 years old. They earn $5 million annually. Their net worth is about $60 million. The business is worth about $50 million. And so we're going to set up an irrevocable trust. We're going to use some of the annuity contract rules to be able to sell and basically take back a portion of that $50 million over their lifetime. Now, the IRS has some rules on this, and they have some interest rates on this. But in short, let's just say the average life expectancy is 80 years old for the male. Let's say the husband, and let's say the wife is 83 years old. They're going to take the ages of both. Let's imagine they're both 55, and they're going to do a calculation based upon the net proceeds that go into the irrevocable trust. And then they're going to take an interest rate, and they're going to combine these numbers, and it's going to be a portion of that amount of money over time paid back to them. We won't go into detail on that, but just know that the key thing is they will pay some tax as they receive payments back, but on anything that's left inside of this irrevocable trust, it's outside of their taxable estate. Let's do some simple math, and let's just say it grows from 50 million minus the 2.3 million of debt. So we'll call it 47 or 46 after closing cost. At 46 million, if they were to live, let's say to 80, 90 years old, perhaps it's worth about $100 million. Let's just keep the simple math here. Well, $100 million outside of the taxable estate means there's no estate tax on that. Inside the taxable estate, it'd be subject to 100 million minus 30 million at this point for the exemption. So that means 70 million would be subject to the estate tax at 40%. That's a $28 million estate tax. And so that's what's at stake here. So knowing that estate tax of $28 million is what's at stake upon the exit is vitally important before moving forward with the next step, which would be the income and the capital gains tax, which are also very, very important. So what can you do? Well, you can start and build an irrevocable trust with a third-party unrelated trustee. This is part of what we do here at Capital Gains Tax Solutions. Sell it to that third-party unrelated irrevocable trust, although your children can be the beneficiaries of this trust, and anything in there remaining is past estate tax-free. You will pay capital gains tax and income tax over your lifetime and over, if you're married, your spouse's lifetime. So that's something to consider. Not every tax strategy is going to fit every single solution, right? And so you want to look at combination, sequencing, and timing with all of these strategies that you're considering, which will move into the second part of this, which is managing the income tax. Now, the beautiful part about the irrevocable trust structure is it can delay payments to you for a couple years. 1, 2, maybe 3 years before it makes any payments to you, meaning you defer 100% of the capital gains taxes, 100% of the income tax, and you're in a deferral state, which is really good. The second part about this that we're going to combine certain strategies is forming a new LLC, and should you want to buy investment real estate, you have the ability to establish a new depreciation schedule of which the trust can invest alongside of you as a joint venture partner. Now, that new investment that you purchased, let's just say you put $10 million down on a $30 million apartment complex, you're able to depreciate at a new schedule, which is good, meaning you get the majority of the depreciation on this, and you're doing it with tax-deferred money, income tax deferred, capital gains tax deferred, because you haven't taken any personal payments from the trust. This is really powerful because what we're going to try to establish is some paper losses on this side, okay? And if you're a real estate professional status, check with your CPA. If you have a certain amount of hours, you're able to also offset income tax, but at least offset passive gains or passive income. So that's huge on this combination of these two strategies. And so remember, you would have paid, and let's just say you lived in California, you would have paid about 37% on a $50 million gain of a business. That's somewhere around $18.5 million of tax. So we've taken what you would have paid to 10 of the 18.5 and you put it into an investment real estate property, let's say 30 million, and you're getting massive depreciation off that. Let's just say 80% of the 30 million because you have to associate for land cost. The way that we structure with the LLC, you're the majority owner, so you're getting the majority of that depreciation. So this is huge, right? We're doing combination of estate tax planning plus capital gains and income tax planning, and you're doing it in such a way where you're using tax flow, not just cash flow, although you're collecting the cash flow, right? This is good on that investment real estate property, but to the extent you have enough losses, you can offset that cash flow. So I know that's maybe going a little bit too fast here, so I want to make sure you're capturing this. That the mindset is what we're practicing is tax flow, estate tax, alongside capital gains tax deferral and income tax deferral, and we're trying to bring it into multiple strategies to help you multiply and compound your wealth. If you want to learn more about everything we're talking about and maybe see how this specifically could apply to you, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com to get started with myself or one of my team members to build a strategy and a team to help you execute on this. Now I'm going to go back to the case study because I know it's really important to understand that they had $2.3 million of debt, business debt on this particular business sale. Their basis was zero, so that $2.3 million of business debt is not deferrable. It's not, you're not able to take that and defer that. In other words, that's considered constructive receipt at closing if the debt is paid at closing, meaning you would owe tax on that $2.3 million. So just some general tips on planning here. Ideally, you're out of debt before you sell a business, or at least you're out of debt up into your basis. So if your basis is $2.3 million, or if their basis was $2.3 million in this scenario, in that scenario, they have no problems. They can still defer 100% of the capital gains taxes for a period of time, still eliminate the estate tax. But that $2.3 million, if it's above your basis, if the basis is zero, that is not deferable. That'd be a taxable event. So be aware of that. What can you do? You can pay that debt off prior to closing. So it could be 15 days, 30 days before closing. Get the debt paid off, get the debt off of the business. You may even consider, finding a way to bring on debt on something else to pay it off short term, because it's going to be taxed at ordinary income tax rates. And so that's the biggest one, which leads into kind of the next part of the strategy. You might be in New York, or New Jersey, and Illinois, California, and you're saying, hey, how do I get some income tax deferral? Okay, so we kind of talked about the bonus depreciation and the joint venture partnership with active ownership of a property, and you have a certain amount of hours, real estate professional status. But there's also just moving out of state, right? So there's a lot of this going on right now out of New York, out of New Jersey, out of Illinois, out of Minnesota, these high tax states, California, people moving to other states like Florida, Texas, Tennessee, Idaho, Puerto Rico perhaps. And once you establish residency in that state and you start to receive income, the income is based upon the state in which you reside. Now, the nexus of capital gains tax is still going to be where you domicile the business, check with your CPA. So don't get those two confused. If you dip into principal payments, you'll still owe New York or New Jersey or California, but the income tax is based upon where you reside. And so some strategies that some clients have used is simply moving. Moving is a great strategy, and now you establish new residency, so that's some income tax deferral play as well. The last thing I'll leave you with this particular case study is that they are also making not only $5 million of annual income, but maybe they don't have enough real estate. I don't know. We don't have enough fact patterns for this particular case study, but just knowing the value of partnering with best-in-class operators that are really good at mobile home park operating or multifamily or industrial properties, and you're able to partner with them and be able to receive massive depreciation by real estate ownership. That's such a powerful thing. And right now is actually a decent time to buy real estate because values have kind of been down. And so if you want to encourage you to look at a mindset of not necessarily running it yourself, but becoming that partner alongside of somebody and being able to have them operate it and run it. It's also part of one of the things that we are connected with our podcast and our network within the real estate community. And so again, if you want to learn more, go to capitalgainstaxsolutions.com, have a plan, have your clear mission, vision, values for your family, have your clear problem at hand, estate tax, capital gains tax, income tax, what you're solving for, have a mindset of combination, sequencing, and timing, and definitely plan before you do anything, because upon sale of an asset, if you haven't done the planning, you eliminate probably 90% of what you could have done, and really the most attractive type of strategies. And so again, go to capitalgainstaxsolutions.com to learn more. I'm Brett Swarts. I appreciate you watching this video. Please share it with someone it could be of help and of a resource to, and we'll hope to talk to you real soon. Bye now.